Does accounting feel like a complex puzzle with a million pieces? Here's a simple roadmap that explains the entire process from start to finish. The accounting cycle is the complete task of doing accounting. This video breaks down the 7 essential steps of this cycle. We even have a fun quiz at the end to test your knowledge. Let's get started. Step 1. Source documents. These are the original papers or digital files that prove a transaction occurred. Think of them as the evidence. They are crucial for recording transactions and are divided into cash and credit transactions. Here are common source documents: invoices, receipts, orders, deposit slips, bank statements, checks, credit and debit notes, employee time cards, emails, expense reports, contracts, delivery notes. Step 2. Journals. After collecting the source documents, bookkeepers record the transactions in 7 journals, or day books. These are the first books of entry. Transactions are grouped and recorded in particular journals, with cash and credit transactions separated. Also, goods bought or sold for resale are recorded in specific journals, even if they are cash or credit transactions. Journals for goods for resale. Sales journal. For credit sales. Purchases journal. For credit purchases. Returns inwards journal. For goods customers return. Returns outwards journal. For goods you return to suppliers. Journals for cash transactions. Cash book. All cash and bank transactions. Petty cash book. Small cash transactions. The general journal is used to record everything else that doesn't fit into the other journals, such as asset purchases, asset sales, depreciation, bad debts, correcting errors, opening balances. Step 3. Ledgers. Next, bookkeepers post the journal entries into ledgers using T accounts. These are the second books of entry. This is where things start to look more like traditional accounting. A ledger is a book of accounts where all transactions are grouped by account type. Each account is then balanced off at the end of the period. For instance, if a buyer pays what they owe, we close their account. If they still owe money, the balance is carried forward to the next period. The 3 key ledgers are: General ledger. Holds all accounts. Purchases ledger. Tracks what you owe your suppliers. Sales ledger. Tracks what customers owe you. Step 4. Trial balance. The trial balance is a list of all account balances from the ledgers, with 2 columns. One for all debits and one for all credits. The goal is for the total of both columns to match. If they don't, it's a sign that there's an error. It's important to note that some errors, such as errors of omission, a transaction was completely left out, or compensating errors, 2 errors cancel each other out, will not affect the trial balance. Accountants use tools like a suspense account, control accounts, bank reconciliation statement, and draft net profit to find and fix errors. Step 5. Income statement. The income statement, also known as the profit and loss statement, summarizes all income and expenses from the trial balance to determine if the business made a profit or a loss over a specific period. Gross profit equals sales minus cost of goods sold. Net profit equals gross profit minus operating expenses. If the net profit is positive, the business made money. If it's negative, it made a loss. This report is a key indicator of your business's performance. Step 6. Balance sheet. The balance sheet or statement of financial position is a snapshot of your business's financial health at a specific point in time. It summarizes all assets, liabilities, and capital from the trial balance. It's built on the fundamental accounting equation: assets equal liabilities plus capital. The balance sheet lists: assets, what the business owns; liabilities, What the business owes. Capital or equity. The owner's investment plus any profits. The net profit from the income statement is added to the capital section. Business owners use this report to make important decisions about expansion or financing. Step 7. Cash flow statement. It details cash from 3 main areas. Operating activities. Day-to-day operations. Investing activities. Buying and selling assets. Financing activities. Loans. Capital injections. This statement gives a clear picture of the business's liquidity, helping to explain why a profitable company might still have a cash shortage. It works with the income statement and balance sheet to provide a complete view of a company's financial status. Let's make sure you know the accounting cycle. Source documents. Invoices. Receipts. Orders. Deposit slips. Bank statements. Checks. Credit and debit notes. Employee time cards. Emails. Expense reports. Contracts. Delivery notes. Journals. First books of entry. Journals for goods for resale. Sales. Purchases. Returns inwards. Returns outwards. Journals for cash transactions. Cash book. Petty cash book. Journal for everything else. General journal. Asset purchases and sales. Depreciation. Bad debts. Correcting errors. Opening balances. Ledgers. Second books of entry. General. Sales. Purchases. T accounts. Balancing of accounts. Balances carried forward. Trial balance. Account balances from the ledgers. 2 columns with all debits and credits. Finding and correcting errors. Suspense account. Control accounts. Bank reconciliation statement. Draft net profit. Income statement. Profit and loss statement. Income and expenses from the trial balance. Gross profit equals sales minus cost of goods sold. Net profit equals gross profit minus operating expenses. Positive figure means profit. Negative figure means loss. Balance sheet. Statement of financial position. Assets, liabilities, capital or equity from trial balance. Accounting equation. Assets equal liabilities plus capital. Net profit from income statement. Cash flow statement. Operating activities, day-to-day operations. Investing activities, buying and selling assets. Financing activities, loans, capital injections. Business liquidity. Cash and cash equivalents. Be sure to check out the videos on each step of the accounting cycle on this channel. Now that you've got the basics of the accounting cycle down, it's time to test yourself. Ready? Look at the steps in the accounting cycle. Source documents. Journals. Ledgers. Trial balance. Income statement. Balance sheet. Cash flow statement. Try to match each term that appears on the screen with the correct step in 5 seconds. Go! Invoices. Source documents. Day books. Journals. T accounts. Ledgers. All account balances from ledgers. Trial balance. Income and expenses balances from trial balance. Income statement. Assets, liabilities, and capital balances from trial balance. Balance sheet. Business liquidity. Cash and cash equivalents. Cash flow statement. Accounting equation. Balance sheet. Gross profit equals sales minus cost of goods sold. Income statement. 2 columns with all debits and credits. Trial balance. Second books of entry. Ledgers. Books of original entry. Journals. Receipts. Source documents. Financing activities. Loans. Capital injections. Cash flow statement. Book for all cash transactions. Journals. Net profit equals gross profit minus operating expenses. Income statement. Book for credit sales. Journals. Balances carried forward. Ledgers. Assets equals liabilities plus capital. Balance sheet. Small cash transactions book. Journals.